Good morning. Whoa, that one's really loud. I'm Joan Gilman, and at one of our meetings, I said, you know, we do a great job with the U.S. economy, and Steve Rick does a terrific job for us every December talking about what's going on in the world, but we need to do something other than just national economic. So that's why you're here today, because I really do believe that we need to understand what's going on in the United States. But somehow in Madison, Wisconsin, we feel like we're this island and that, you know, we're kind of insulated, and we're not. We're impacted by the rest of the world. And I wanted to hear what was going on in the rest of the world. So that's why we're here. Sarah is a senior strategist, regional director of investments with BMO Harris Bank, private bank. Or she just calls it BMO Private Bank. Do you drop the Harris? Okay, BMO Private Bank. I'll drop the Harris. She leads a team of experienced portfolio managers to develop and deliver BMO's investment strategy and wealth management services to high net worth individuals. Oh, well, I don't qualify. Families and organizations. Sarah holds chartered financial analyst designation, and her education includes an MBA from the University of Wisconsin-Milwaukee, undergraduate studies and a BS from Parkside, where she majored in finance and economics and graduated magna cum laude. So when I couldn't find somebody at the university to talk to us about global economics, I went afield and went to Milwaukee, because I was told that at the UW, we wouldn't be able to understand them because they don't speak English well in the international department. What can I tell you? This is what life is like. So would you join me in welcoming Sarah Walker?
Okay. Well, good morning. It's great to be here. And I am here because I want to be here and because I love talking about the economy and the markets. So it's really a pleasure that you are interested, and so I'm so glad. I also wanted to mention that I do not have all the answers. I do not have a crystal ball. None of us at BMO do. But I welcome your questions, and I will do my best to answer them, and I will do my best to speak plainly, because not only do we all in our worlds deal with accents and struggle to understand sometimes, but we also deal with lingo, and the financial industry is rife with lingo. And what breaks my heart sometimes is when I'm involved in a meeting when people in my industry are talking and they're using too much of it, and the poor person that's listening to them has is just eyes are glazing over. So I think my industry is guilty of making things a little more complex than they need to be. And so that's another reason why I'm here. I feel like I'm an ambassador for the economy and for the markets to help people understand and feel comfortable. So again, I'm a resource, happy to be here. What I thought I'd do today is talk, let me take a step back. Probably 20 years ago, I was giving a speech in Madison, and a gentleman in the audience said, you know, you're just like a weather girl. You know, you kind of talk about things and you make forecasts and then you tell us what happened. And at first I kind of bristled, and then I thought, you know, I'm going to just embrace that. And so when you think about a weather, when you watch the news and watch the weather, they always start with a review of what's happened, even though we all know it, but we've all lived through it. I think Wisconsinites in particular, because weather is such a changeable part of our lives, that we are all glued to the TV and we're listening to what we've lived through, and then we listen to the forecast, and then we make our plans. And I thought, that's a pretty good format for this presentation. So I will spend some time on what has happened, not too much, because I know you're here for more of an outlook, but I'll spend some time on what has happened just to help lay the foundation for where we are, what we've come through, and how that is affecting where we believe that we're headed. So that will be the format, review, and then a talk of conditions currently and our outlook. And then I'm going to wrap up with, well, what do you do with this information? I think that's another challenge for the financial industry. The industry, it's a wonderful industry that I'm proud to be part of. People in the industry care about their clients. We're always reminded about our clients and taking good care of them. And we love information. We're typically quite analytical, and we love to talk about it, and we love to share. And but then we get to the end, and someday I've often received the question, so, and so I will try to orient my comments to, well, what are some takeaways for you? And that's, at any time, I welcome your questions, but especially in the end, if you have questions about your own portfolios, what you might be thinking about doing, what you might have heard, talked about, and if you'd like some more explanation of that, consider me your resource. So with that, you'll also notice that I have paper up here. I have a computer, I have paper, I have a clicker, I'm all set, but I still am of the generation that likes paper and likes notes, so I might be fuddling a little bit with some of my papers just to prompt my memory on some things. And you will notice at the very end a slide that reflects my love of paper. So we'll hang in there. So what are we starting with? Well, you might wonder, well, what kind of title is this? Investment Success in a Shrinking World of Global Growth. And I chose that for a couple of reasons. One, we are in a global environment, and investment, whether or not you have a 100% domestic portfolio, you have global exposure. So in many respects, it's a shrinking world. We're tighter, and we're tied together and connected more and more. So in that respect, it's shrinking. In the other respect, the globe is growing, and different countries are growing faster than others. So that is where that title came from. That in some cases it feels like a smaller world because we're so connected, and then in others we know it's just growing and growing. So that's the title. My first chart, and so I'm going to talk about the charts, but I also will go off a little bit. They're here mainly to kind of help me just remember and remember my talking points. So what I have here, this is on the theme of what happened last year. And you'll see that this is showing the percent of asset classes that were providing a negative return in 2018. And you can see that it's pretty high. And so it's almost as high as in 2008. So last year was a challenging year in the markets, and it was unusual. I mean, as you can tell by the bar chart, it's not normal that such a high percentage of asset classes were in negative territory last year. I actually went to a presentation last night where the chair of Northwestern University's endowment committee, so they are responsible for $11 billion of endowment monies, and he mentioned that in the same vein, one of the best performing markets last year was the Japanese bond market. And the Japanese bond began the year with a yield of 6 basis points. So when you think about that, what does that mean? It means 100 basis points is 1%. 6 basis points is 6/100ths of 1%. That's the yield. For that market to be the best performer, that means that yield either stayed steady or declined. A yield on a bond at 6 basis points either stayed steady or declined, and that was one of the better performing markets in the globe, around the globe last year. Not a high benchmark. Also, the other message to remember, and that is a theme throughout this presentation, the other message is that what a low interest rate environment we are in. It's better than it was, and we were talking about savings rates have come up. And I'll talk about that a little more too, but still, all in all, a very low yield, low interest rate environment. So this chart I just have here to highlight how challenging the year was for investors, and how interesting it was that one of the best performers was something that set a very low basis point, low benchmark for us. The year began much differently, and the markets were having a much better year than where they ended. And what happened is we had a willingness to take risk in the beginnings of the year and throughout the middle of the year. And then suddenly in that fourth quarter, there was a real pullback, a pivot away from taking risk. And investors in general became concerned about many things, and I'll get to those in a minute. But the tone, and again, a theme that we're seeing the opposite of today, was in the fourth quarter, investors suddenly just didn't have the appetite to take risk. And that is reflected in the high percentage of markets that did not do well in 2018. My next chart is highlighting the returns and pullbacks. And so this is highlighting what with the other conditions for 2018. So first of all, we had a pretty good year as we were going along until the fourth quarter. And we also had incredibly high volatility in that fourth quarter. It felt even higher when you look at 2017. So I'm going to try my technology here, and let's see. Oh, there we go. So if you look at 2017, the number of trading days with a move of plus or minus 1% was incredibly low. Much lower than the average. So the average is about 70, and we had 8 days in 2017. And in 2018, there was some periods of increased volatility, but generally it was pretty level until that fourth quarter. And then we had a jump, which felt like the beginning of the end. And there were if you watch CNBC, you might notice there were all kinds of headlines and reports about, this is, we're getting into correction territory in the stock market, and then we're getting into bear market territory. And the focus was on volatility, which can be upward and downward, but in the fourth quarter, the focus was on the downward volatility, and nobody likes that. And when you look at the numbers, though, it was just it was still below average, but it was such a significant shift from 2017 that it felt like the world was falling apart a little bit in that fourth quarter. And that just highlights that we're seeing, we've got elevated markets, elevated valuation. People are more sensitive to the chance of a problem and to the worries of a problem. And so the volatility spiked up. Interestingly, we will see in the fourth quarter, things turned around very quickly. But throughout, until December 26th, really, it was a scary time and something that we just weren't used to. So let me here. Now, now, here's the highlight. What a difference. I put what a difference a month makes, but really now that we're well into March, I should probably say a month or 2 or 3. But if you want to focus on this chart, and again, I'm laying some foundation, so I know I'm looking at things backward, but now I'm shifting a little bit into current day. But it's just to highlight how things change and how quickly they can change. And part of it is attitude. But you can see that if you look, there's always, I hate busy charts, so Joan and I were talking, and I had a few busy charts, so I tried to pull them back and make them so that you can see them, because I hate that too when you're in an audience can't read. I focus on the yellow bars, which are year to date through the end of February, and then the pale blue bars beneath, because the comparison is Where did we end 2018 with different categories of investments, of stocks and in commodities? And where are we in 2019 so far? And so you see the pale blue bars are all in negative territory. That's reflecting my first chart, that it was a bad year across the board. And then look at the yellow bars for the first 2 months of 2019. The incredible return that we've seen from the equity markets. And this is the one message. So when you're driving home and you're thinking, what did she talk about for 2 hours? A message is in this chart that you can use personally with your investments. It's why money managers always say to think long term, to review your portfolio, to review money managers that you may be interviewing with a longer term perspective, because just a month or two can make a huge difference. And I've seen that. I've been in the investment community and in the investment profession for, let's see here, it'll be 36 years. And I have seen my share of people who get spooked or something has made them very uncomfortable, and they make a kind of a snap decision based on very short-term information, and they make a decision 9 times out of 10 they very much regret. And they can do significant damage to their portfolios. I've got some charts that'll highlight just how damaging it can be to react to a short-term scenario and make a major change, and then what happens when you miss out on a recovery like we've had. Did I know, did BMO know, did anyone know on December 26th that we would start this amazing recovery? No. You'll talk, some people will say, if you watch CNBC, there's a number of talking heads that will tell you, oh yes, I knew. But believe me, we don't. We don't know what's going to trigger a switch like this. But we do know that if we stay steady, and if we have a diversified, balanced approach, if as a professional, if we listen to our clients, and as a personal investor, if we're very careful and thinking about our own behavior patterns and our own needs for our money and our own time horizon and our own behavior, how do we react to uncertainty and fear? If you take all those things into consideration, you'll find that you'll be able to just go through periods of volatility like this. And you wouldn't have sold out at the bottom and missed a recovery. You kind of stay steady. What I find too in my career is that's not always the attractive response to a question about, what did you do when the market was cratering in December? What did you do? People want to hear, well, I did this and I tweaked that. And quite often the best thing to do is nothing, to sit steady and to remember why you're investing and what your needs are with that money. But when you think of going to a cookout or a cocktail party, nobody really wants to, oh, you did nothing? Okay, next, I'll go move on and talk to somebody else. It isn't, it doesn't have the attractiveness of action, but long term, it has the better results. So that's what is happening right now. And now I'm going to turn to the fixed income markets. So the fixed income markets this chart can tell you numerous messages. And again here, I would focus on the light blue bars and the yellow bars, comparing them to each other. There's two extremely interesting, if you're a geek like me, there's some very interesting developments on this chart. So I'll focus on one. Risk on the Rise is the title of the page. The reason I make that statement is if you look at the U.S. corporate high yield set of bars, that's what we in the industry, when we talk about, high yield, the common name and the name that it's really talking about is junk bonds. So when you hear people talk about junk bonds, what they're talking about is below investment grade corporate debt that companies have issued that is close to maybe not being repaid. Now there's a spectrum. It could be closer to not being repaid and be very low rated, or it could be maybe the sun is on the horizon and it's close to being upgraded to investment grade, but it's below investment grade. That is what is known as junk debt, junk bonds, also known as high yield. People, it's a bond. You know, we're talking about bonds, so we're talking about debt that General Motors has issued, General Electric has issued, but the high yield market itself, that subset of the bond market, is very much like an equity, like a stock. It behaves more like a stock than a bond. Because people who are investing in junk bonds, they're not doing it because they want that foundation of safety that bonds typically provide and that pay a lower return, a lower yield, but steady and something to kind of bank on. When you invest in junk bonds, you're really saying, I'm betting that the economy is going to improve and that these junky bonds are going to be repaid and maybe be upgraded in their quality. So that's why we say it's more like an equity. And that's why this one bar is so different from the others. So one set of bars. So when you look at U.S. corporate high yield, this chart is telling you a couple of things. It's telling you, very much like the prior chart showing the equity returns, that it was not a good year for risk in 2018. That's the pale blue bar. And that, whoa, it's a good year for risk in 2019. That's the gold bar. So year to date, junk bonds have done very, very well. I mean, that's a return. That's just through February. That's a 2-month return. Just think of that. That's a great year in junk in any market, really. But that's a 2-month return. What does that tell you as an investor, and what is part of the message to take away today is that right now there is a willingness of investors to take risk. There's an underlying confidence in not only the domestic economy but the global economy. And that what I've learned sometimes the hard way in my career is bond investors, that's the bond market. They're very perceptive to risk. And so this is telling us that when they look ahead, they don't see a recession, that's for sure. And that's a headline we're not reading about it too much right now, but in December especially, and in January, and in February, many of the questions I would receive when I would do a presentation was, what about, is the recession on the horizon? And that's still a valid question, and we'll discuss that at any time. But the bond market is telling us, in terms of the attitude about risk and the economic outlook, that no, one isn't really on the horizon. So that's the story with this chart. There's another story with this chart, and this was actually brought up last night, so I'm borrowing from my new friend, the chair of the endowment committee at Northwestern University. He spoke to the CFA Society last night, and it was just fascinating. And he made the point, and you can see it on this chart, what's really the second message, and what is so odd right now, is that if you look at the other categories of bonds, so there's U.S. municipal bonds on the left, the aggregate bond market in the middle, and then global aggregate, you're seeing that those markets have provided a positive return. You're seeing a couple of things. They provided a positive return in 2018. Well, that would make sense. When people are fearful, like they were in the fourth quarter, what do they tend to do? They tend to shift, or they tend to move into bonds because they're fearful of stocks and fearful of a recession. So makes sense that 2018, the pale blue is positive. What's odd is look at the yellow lines for the bond markets in 2019. They're equally positive. If we're just, again, for a couple of months in 2019. That's unusual. You know, so typically when you see investors say, I'm willing to take risk, I'm positive about the economy, they're also, A, seeing, bonds are kind of boring, I don't want bonds. B, they might also be saying, you know, if I'm that positive about the economy, I got to start thinking that maybe inflation is around the corner, and with inflation being around the corner, investors typically turn away from bonds. So the fact that people are go toward the equity markets and they're go on bonds is not normal. And so and do I have an explanation for it? I have a partial explanation, but I will tell you, it is a bit of a head scratcher. The positive explanation, or the partial explanation that I have is this chart does reflect what happens when you have a very accommodative central bank. And we have a very accommodative U.S. Federal Reserve, and we also have very accommodative global central banks. And so you might remember back in the heyday of the recession, the central banks embarked on quantitative easing. That was a strategy they had that, in addition to lowering rates to zero or below, the official target rate, they also pumped liquidity into the economies. And there was some criticism about that. Now, I'm not really in that camp. First of all, what difference does it make if I were the Federal Reserve, and the central bankers are, very learned people, and certainly have all the tools and all the data available to them. But secondly, that recession was one of the worst economic calamities we could live through. They had to do something, and they pulled out all the stops. But if you are a student of the markets and the economy, what you constantly read, or a very common theme, is that when the central banks are that willing to push liquidity into the markets, the verdict is out, but what happens is, the question is, do they really help the economy, or do they just pump up the value of assets? Bonds or stocks, bonds and stocks. And this chart, especially, and I'll get more into the Fed in a moment, but this chart is suggesting that all financial assets were helped by the Fed's change of heart in December. So there's a lot of facets to that chart, but that's one theme, that's one headline you might be reading. You might be wondering, especially when you read about the widening income gap and the wide disparity in our society. A thread from that discussion is, well, the Federal Reserve, the central banks across the globe, when they've embarked on this quantitative easing, what it's really doing is contributing to the bubble in asset prices rather than really helping the economy. And that's a theme that you might be reading, and I'm just trying to illustrate it for you. So that's underway as well. I also think that the fixed income markets are subject to a lot of distortion because we are in such a low interest rate environment. And so a lot of the, I wouldn't say rules, but just some of the thoughts and ideas about bonds, I will not utter the words that any investment professional would die before they'd utter, which is, it's different this time. We're always told that when you hear that, run the other way. So I'm not going to say it's different this time, but I will say that all of that easing and that efforts to recover from the recession have just added another element to the bond market that makes it a little difficult to overlay old past ideas and conditions onto today's bond market. So, enough about bonds. So my next chart, now I'm going to pivot into, okay, what's happening now? Where are we? And this is, I like to, anyone who's heard me give speeches in the past knows that I do like to use pictures rather than slide, and the charts. And so this is one example. And so what I did is I thought, now how do you take all that information, as an example I just gave you, how do you take all the information that we're inundated from the likes of CNBC to social media, how do you filter it? How do you use it to your advantage? What do you do? And I will say it's very hard to stay focused. And it's hard for professionals and people investing on their own as well. So it's something that my entire team, my entire industry, you could tell by the questions last night at the CFA Society dinner, we all wrestle with how do you filter through so much information that we're just getting inundated with. And there isn't a real good answer. I tried to explore this by showing noise cancellation headphones, that it is, in my opinion, it's becoming more important to stay focused because we have so many opportunities to go off, and you have a lot of opportunities to think that the sky is falling. I've seen that in my career, and I see it more and more. I'll talk to clients, and you know, the headlines that we're bombarded with, many of them are quite disturbing, and they're worrisome. And it's easy to make a decision, to think the correct decision is to just pull out all your money from the markets and go into cash. And I've seen that as a mistake. So this chart, this picture is just to highlight the importance of staying focused. Now, as a professional, what that means is we stay focused on our clients, but for you, you're here and you're interested in investing, you're interested in your own portfolio, well, how does it help you? It just, I'm using this just to highlight, again, that importance of thinking, when you think of your own money, think of what you want from it. I do meet with a lot of people who say, well, I want to do double the S&P 500, that's what I want from it. And then you think, well, okay, that's a starting point, but you know, really, does the S&P 500 and what it does matter that much to you, or are you trying to build a legacy for your children and grandchildren? Are you trying to build a legacy for philanthropy? Are you trying to just make sure you have enough such that you are comfortable throughout your days? You know, those types of questions, in my opinion, and this is what I do with my own personal money, is they're much more important to me as a personal investor than am I going to beat the S&P or not, you know? And I think I have seen people lose sight of that, and I've seen some people make some mistakes because of that. So again, how do you stay focused? Just go back to what is the purpose of this money, and that purpose will help you with lots of other questions, of course. Figure out, you know, if you need to, if it matters, well, here's a perfect current example, Boeing. So Boeing's in the news right now because there's some problems with its jets. And the stock has taken it on the chin. And, you know, the verdict is out. We don't have all the information yet. But I will say that in my career, what I've seen is when you have a harsh reaction to what is bad news, I'm not dismissing that, there's typically an overreaction. And so if you're thinking, well, you know, the globe, we're seeing improving global standards of living. We're seeing global growth. We're seeing jetliners become more and more fuel efficient. We're seeing technology enhance the fuel efficiency and even more, and technology also enhancing the production of oil. So, I think, those are some basics. Again, this is very basic, but those are some thoughts that would lead you to think that a major aircraft producer is probably going to survive. And that's the type of thinking when you have this bad headline and you go back and you think, oh, I'm going to sell my Boeing. Maybe you don't want to sell all of it. If you're fearful and scared to death, well, you got to pay attention to that. But maybe if maybe don't do anything, maybe buy it. Or maybe if you feel like you have to do something, either buy a little or sell a little. But I've seen a lot of people make very significant decisions on a headline, and they forget, why did I own Boeing? So that's enough about that. So I hope I'm doing all right and giving you some helpful information. Again, if you've got questions, I'm a resource. So what I'll do now is I'll pivot to themes for 2019, but again, I'm open for questions. And we will definitely have time at the end. I am watching my clock, so we're going to have a 10-minute break at 11. So you'll be able to take a break from me, and then you can come back and I'll give you some more information. So what are the themes for 2019? One of the most significant, and we saw that in December, is the Federal Reserve. And what I would say is, it says the Federal Reserve, it probably for purposes of today, for Joan's interest in the global economic situation, you might as well say that that's a stand-in for global central banks. So the central bank, the monetary authority of the globe, so meaning the European Central Bank, the ECB, the Bank of Japan, the Bank of England, the Federal Reserve, the Bank of Australia. They have slightly different names, but they're the central bank. They're the monetary authorities in the developed and developing world. And what those bankers and what they're doing and what they're deciding, it has a major impact on the financial markets and on the global economy. It's easy for those bankers to make a misstep. That's why they are very well versed in how to say something without saying anything. But we can see the impact they have on the markets and on the economy. So that's a central theme for 2019, is to watch what are they doing and what's coming from them. Global trade policy also weighing heavily on people's minds. Sometimes I've wrestled with this. I've thought that there's maybe been a little too much attention paid to this. It's we'll get through it. There's a lot of noise out there, and we'll get through it. And I feel that way to a point. But where you see the impact of trade policy and where you see the impact of uncertainty about trade policy is when you talk to businesses. Businesses need to feel confident when they make long-term investment decisions. And when you've got conditions changing and markets changing because of tariffs or sanctions, it affects their decisions and typically makes them hoard cash, and that has an impact on the economy, domestic or global. So that it is important, and sometimes I just think it maybe took over too much of the headlines, but we'll get to that. And then Chinese economic growth. Here's it's a little murky. And there's a lot going on. We'll talk about this. But some of the highlights are, you always have to remember with China, you're dealing with a command economy. So it's different from the U.S., from a market economy, and it's becoming more market oriented, so market aware, shall we say. But it's still a command economy, and I've caught myself sometimes in my reading and my studying and my thinking, I'll think, well, you know, they're advancing, they're developing, but then I always have to be reminded they are a command economy, and so meaning their policymakers will do what they think is best and and work to achieve their goals and objectives, and the markets don't have the power that they do in a market economy like the U.S. So and the reason I go into that is some of the data that's coming out of China is, you know, we don't really know. It's hard to track it and hard to measure it and hard to know if it's how accurate it is or if it's just part of the message. But we do have enough measurements, and there's enough intelligence going on that can verify some of the numbers. But it's still it's a little murky, and it injects some uncertainty, and investors don't like uncertainty. So, but it's a bigger and it's a growing area of uncertainty. It's a growing part of the globe. So we'll certainly talk about that, and that's why it's one of the major themes. To that point, I'll give you some numbers that you might find interesting. So global GDP is about coming in for 2018 at about $80 trillion, US dollars. The US economy, so the US GDP, and these are nice round numbers, so it's very easy to think about, is coming through at about 20 trillion. I remember when when I started to do more speaking about the economy, we were hitting 10 to 12 trillion. And I'm probably dating myself in some respects, but I like to think that that wasn't all that long ago. So now it's 20 trillion is the US economy. China. Anybody want to venture a guess what the size of its GDP is? So we've got 80 global, 20 US. Anyone want to venture a guess about China? 40, did you say? 40? Anyone else? 5? Yes. It's 12. 12. You might be thinking of percent, but which is not China, but yeah. So anyway, 80 trillion global, 20 trillion US. China is 12 trillion. The third largest economy is Japan at 5 trillion. And then now I'm going to give you another number that I also want you to think about and take away with. So again, when you're driving home and you're thinking, oh, did she talk about the U.S. consumer? You might read this in articles. It's always referred to that U.S. consumers, what we do, our decisions, buy, sell, invest, determines about 2/3 to 70% of the U.S. GDP. So if you say, okay, let's just say it's 70%, so 20 trillion, 14 trillion is the US consumer. China is 12 trillion, if you believe the numbers. So the US consumer alone is the second largest economy, if you want to carve us up in the globe, and we're bigger than China. And that's one reason why I certainly do not ignore China at all, because it is growing very quickly, but I do spend a lot of time in my work, and at BMO we spend a lot of our time on what's going on with the US consumer, because we're bigger than China. And that's one reason why, in my opinion, you've seen such a market rebound, is because okay, we had a lot of concern about the Federal Reserve in December. Were they going to continue to raise rates? Were they going to put the brakes on the economy? And then we realized that maybe they weren't. And then you start to think, my gosh, the second largest spending power in the planet is increasingly employed and is starting to see wage growth and is confident. And that's not the whole story behind the rebound in the markets, but it's quite a factor. And it's something that we pay a lot of attention to. So I just thought those numbers are kind of interesting. So that's something to think about. And I think, well, let me take a step back. The Federal Reserve, another reason, I've talked about this, but this is a comment that you might be reading about and you might be wondering, what does this mean? The reason that we have the Federal Reserve as one of the top 3 themes is exemplified by what happened in December. So when the market turned in December, it was after the release of the Federal Reserve minutes, and you saw what they call in the financial headlines, the Powell pivot. And if you saw 60 Minutes a few weeks ago, you might have heard and seen more about that. What that's referring to is Federal Reserve Chairman Jerome Powell pivoted in December. He went from posturing and preparing us for more rate increases to saying, I'm not so sure, without saying that. He just used some Fed speak and mentioned that he was going to be more patient. And that pivot, in addition to some of the consumer news I was just highlighting, but I would think the main driver of the extreme reversal in the markets starting in late December was that pivot. The idea that, the Federal Reserve, and therefore other central banks, maybe they're not going to be continuing to raise rates, which is the same as tapping on the brakes of the economy. Maybe they're going to hold off and lower rates, more accommodative monetary authority. Those are good things for stocks and for the economy. So that power of that pivot is one reason why this is a key theme for us for 2019. So, let's see. Okay, here we go. So, central bank policy. So I'm starting with the Fed and with global central banks. And these are some charts just to give you a little bit of a backdrop of what the central banks have been doing and the impact that this has on the markets, and then the hope that it has on the economy. So if you look at the upper left chart, which is probably better or more readable on your paper format, this is showing total assets. And you might be thinking, well, what does that mean? It's the size of the central bank's balance sheet. And the message here is to look at back in 2006, where the green is Bank of Japan, the blue is the European Central Bank, and then the black is the Federal Reserve. So if you look, and I guess a number to give you some metrics is the U.S. Federal Reserve had a balance sheet size of about $800 billion before the financial crisis. Financial crisis comes on, they're desperate. What can we do? What can we do to promote the economy, to inject liquidity? They lowered rates to 0. They also then started buying assets, building their balance sheet to spread the money into the banking system. And as they did it, so did the other central banks. And so you see this amazing growth from $800 billion up to $4 trillion. Just think of that. And so that I include that. I know it's past looking. The reason why I include it in terms of going forward is that it's almost like, to me, it represents almost like a drug. I think the central bankers, they injected that liquidity, and it is hard to put that toothpaste back in the tube. And so they're working at it, they're chipping away, but it's kind of fun to have that liquidity. And the minute there's a concern about economic growth, it's very easy for the central bankers to say, maybe we won't build our balance sheet to $5 trillion, but maybe we won't peel it back to $3 trillion or $2 trillion. Maybe we'll stay at this, current, I think it's $3.5 trillion right now for the Fed. And the other central banks, like European Central Bank, they're not whittling away at their balance sheet. They have, I think they finally have stopped adding to their balance sheet, but they're not pulling back. So as bonds that they're buying mature, they're replacing them. Whereas our central bank has said, we don't need that much liquidity, so as things mature, we're not replacing them. The main message for you is there's a boatload of liquidity that was injected back in the recession and is still out there, and it's difficult. I'd say it's easy for central banks to say, maybe we'll work on chipping away at that balance sheet next year. So it's much more complex than that, but the general message is there's a lot of liquidity out there, and it's hard for a central banker to pull back on it. No central banker wants to lose their job, and they certainly don't want to have the albatross around their neck that they tapped on the brakes too hard and tipped the economy that they're responsible for into a recession. So that keeps us thinking that we are going to stay in a relatively low interest rate environment. It's better than it was for savers, but it's we're still in a lower interest rate environment. And originally, I remember when the Fed started to go from 800 billion down here back in before the crisis hit, we'd never done this before, and there were thoughts that, well, once they finish, they'll go back to 800 billion. They're not going to go back to 800 billion. They've gone from 4.2 trillion, and I think it's at 3.5, and maybe they're talking about their plans for going to 3, but that liquidity buffer is out there and part of our world. Then, on the right-hand side, the federal rate path, the Fed outlook. Now, somebody might say, what are you talking about? The Fed funds rate, that's their target rate, is nowhere near 2.9%. These are averages of nominal rates. And what it's telling you is they're trying to, it's just in their planning, what do they consider? What are they talking about when they're in their open market meetings and their other Federal Reserve meetings? And what it's telling you is, again, a pretty low, benign interest rate environment, and one that went down after December. I mean, there were thoughts that it would the rates were going to continue to be on a path upward. And that plan is pretty much reduced. I mean, most forecasters and forecasts have a high chance of being wrong, but they're still very interesting. But most money management firms, most forecasters are suggesting maybe there might be one more rate increase in late 2019. But that picture has really changed since December, that there's just a pullback on what the Fed and other central banks might do. So the message is it's a stimulative monetary environment and continuing to be a relatively low interest rate environment. Global inflation. So why are the central banks not tapping on the brakes too hard, and why are they very comfortable staying with liquidity? Typically liquidity and typically a strong economy brings about inflation. So remember when I was mentioning how unusual it was that the bond market was in a positive return category as well as the stock market. Typically, when the stock market is raging ahead, you think, oh, the economy's chugging ahead, and then you start to think, when are we going to start to see inflation? And inflation threats are what make the central bankers around the globe say, oh, I'm just tapping on the brake, I'm going to raise rates. So we've got this liquidity, we've got an absence of them feeling the need to tap on the brakes, and we've got markets that are very healthy, we've got global growth. Do we have inflation? And you can see by the chart on the left, Not really. Inflation continues to come through in a very contained manner. It's at or below the Fed's target, at or below, it's very much below the European Central Bank's target, the Bank of England's target, and it's mystifying to many, to people, students of the markets. So, you know, we should be seeing inflation. We've got record low unemployment. You know, companies say they can't hire, and when they do, they're raising wages, which is one source of inflationary pressures. What is this? What's going on? How can we not have inflation? And the fear is we're missing something. So somehow it's there, but we're just not, it's not coming through in the final numbers, and so any day now the Fed's going to tap on the brakes. So that was a lot of the worry back in the fourth quarter before the pivot. But we had some numbers that came out, just the CPI just came out. It's benign. It doesn't mean that there aren't pockets of inflation. Always keep that in mind, because all of us can cite examples of, I went to the store, I went to the gas pump, I saw the higher prices, but the overall level of inflation is very contained. At this late stage of the economy, the expansion, that's unusual. Personally, and I've got my final chart when we get back from our break, we'll highlight that. I think a big reason for that is the impact of technology. And that's something that gives me a lot of optimism going forward. It's not perfect, and technology can be a big and mean disruptor to lives. But as an overall, from a macro standpoint, when you consider the use of artificial intelligence, when you consider blockchain technology, which is the technology behind all the cryptocurrencies, there are so many new ideas and so much innovation out there, and in my opinion, that is contributing. It's not the only reason, and it's not perfect, but it's contributing to the idea that we're not in a world of inflation. Will we never be? No. So another thing, investment people, we can't say never, and I won't. I'm sure at some point in our lives it'll come back, but it's been contained for a long time, and there are a lot of containment factors out there. One of them is behavior. We're still coming out of the recession, and that affected human behavior, that affected purchasing behavior quite a bit. There's other reasons, going back to just as an example, and then I'll break because I know everybody's getting tired. I talked about the Federal Reserve and boosting asset prices. Well, many of the holders of those assets are in higher categories of wealth. People who are at the higher ends of the wealth spectrum save more. So suddenly you get this conundrum from a and that's why the Fed has been criticized somewhat for contributing to for the fact that the quantitative easing didn't boost the economy as much as you'd think. It boosted asset prices, but most of the assets are held by people of means. They don't need to spend all their money. They save a lot of their money. So they're saving, and we've got more disparity, and we've got people who are saving instead of spending, so we don't have that spending pressure that brings about some form of inflation. So it's like a puzzle. All these pieces fit together. But I am going to stop because it's 11 o'clock. You've been on a very attentive audience. Quite honestly, I've never been asked to speak for 2 hours, so I don't want to bore you. I hope it's been interesting, and when we come back, there's more if you want. And also use the break to think about questions, because I'm here for you. So thank you. Okay, we're back. Y'all came back. That's great. Thank you. I was panicking. I thought, is everybody going to leave? So, again, I appreciate your interest, and it is a joy to be here. And I don't know if I'll cover every one of Joan's requests, but I'll certainly try. And we have time for questions. That's a luxury that we can take full advantage of. So let's see here. So we're talking about the fact that inflation is rather contained. And it's interesting, when I think back of my career, I started my career when money market mutual funds were paying 15%, and when inflation was double digit. My first mortgage on my first house was 13.75%, and I worked for a bank, so that was a deal. And I remember my father-in-law at the time had a 4 or 6% mortgage, and I remember sitting down thinking, I wonder if I'll ever see that in my life. And then I did, and then I'm at 2 7/8 or something. You know, it's just so interesting how our world works and what can happen and what you think is never possible, and then it does happen. So it's all very fun, and I think all in all lays a foundation of real optimism. Bad things can happen, and they will. I talked to a gentleman after my comments about distortion, and that is a great term that is out there that we are dealing with, and I didn't say it as clearly as I should have, but it certainly ties to that idea that all that liquidity that we talked about with the central banks injecting into the economy, and then how it's been boosting asset prices, which I was referring mainly to financial assets, but you can see it in many markets, that it's real estate, buildings, it's flowing to those assets and creating disparity and also creating distortion. And distortions end. They don't end well usually, and so and I'm aware of that, and I think we all are. And it just highlights the need to be, to not bet the farm in your investments, to not fall for a sure thing when somebody talks to you about your portfolio, and to take baby steps, take small steps, have everything in moderation. I'm amazed at how often that phrase comes back to my financial life, your financial life, and our dietary situation, et cetera, et cetera. So now, to go forward, so we've got inflation, talked about global inflation is also low, and I think a message to have here is, it says U.S. CPI tracking forecast, blue chip consensus. Forecasts, again, have a high chance of being wrong. What's interesting, and why I included that anyway, is the expectation. So with inflation, a driver of markets, a driver of global central bank behavior, quite often is the expectation of inflation. And so when you may have low inflation, but if people are thinking it's right around the corner and they're buying now to buy it before it goes up in price, they will then create inflation. So what's interesting and what's positive is that the charts are showing that not only is inflation contained, but the expectation for inflation is very contained. And I think personally, that's a benefit to our outlook and to our current market situation. Got a chart on currency, and I'm not going to spend a ton of time on this because currency, every once in a while I'll meet a gentleman or a woman who is a private investor, and they tell me that they're playing the currency markets. And I mean, they're very astute, but they might as well go to Las Vegas, really, because betting on currency, there are so many factors involved that you cannot, it's very difficult. So I have this chart just to highlight that the dollar has moved up so substantially in 2018, which was a surprise. No one was predicting that. If you remember back, the idea was, oh my gosh, the federal government is spending. There's all kinds of, there's so much debt being issued by the federal government. People will lose confidence in the dollar and it'll plunge in value, and it did just the opposite. It strengthened. And so that has some positives and it has some negatives, but it was not expected. And going forward, it was looking like it was reversing course late in December and then in early 2019, but what's happening now, and this highlights again that interlocking and the global nature, that's again why I talk about the small world. Our rates, the Fed, took the pivot, pulled back, said, maybe not, maybe I'm not gonna raise rates. So typically that leads to a lower currency because investors say, well, if the rates aren't going up in the US, maybe they will in Germany. But then what happened is Germany or the European Union, the Bank of England, they too pulled back on their plans to tighten or to remove some accommodation in their economies. So then we continue to look like we're a pretty good deal. We've got we've got much higher rates on our treasury notes than other governments have on their government notes, and we've got a stable. We've got, relatively speaking, we have some stability and we don't have inflation. So anyway, I think this highlights just how things can change and how difficult it is to make predictions. But we do have a benefit right now of a strong currency that that also contributes to low inflation for us because our imports don't have to be priced higher to offset a falling currency. So it's another reason why inflation is contained. And then we'll get into something interesting called psychology. I have this in here, and let me just move ahead to my trusty notes. I don't want to forget anything. Psychology is a driver, so it's very hard to predict, which is, I've mentioned that forecasts are so often wrong. Well, why are they wrong? Because they're based a lot on human behavior and psychology, and we all know we're interesting. We're not always, sometimes we're very predictable, sometimes we're not. What this is highlighting, though, is that we're neutral in terms of our sentiment. The investor sentiment was at very high levels in middle 2018. Then in December, it moved to very, very low levels. The chart is showing that right now the current percentile is 56, so it's right in the middle of the road. What is interesting about behavior and stock prices, if you look at the upper left, the blue bar, so let's see here. The blue bar is saying that after you have incredibly bearish sentiment, the next 6 months of the S&P 500 are typically about 4.5%. If you're extremely bullish, the next 6 months are 3.3%. And so I put that in there just to highlight the power of sentiment and behavior. So often when like right now, markets have been strong, so suddenly the calls from clients are saying, hey, get me in. And when the time to have gotten in was when the sentiment was very, very low. And so I share that just to give you something to think about when you hear some headlines, that are extreme in one direction. Take that into account when you are looking at your portfolio. So that's more about the markets. Then I move into the small business sentiment survey. That's the chart on the right. And the reason I have that here is it has turned down a little bit in early 2019. That is partly because of the trade talks, and that gets back to what I mentioned very early on, that global trade is certainly an important part of the overall theme and part of the data that's being reviewed when making investment decisions. And one reason that the uncertainty about the global trade environment is being considered is because it makes business decisions very difficult to make. So this is an area of concern. The range for small business sentiment, this is from the National Federation of Independent Businesses, survey, and 72% of the readings are between the 110 and 80 levels. And so it's certainly on the high end of that range, but it's fallen a little bit. And in our opinion, that does reflect just all the news and worry about the trade agreements. And that's the drawback of that uncertainty, is that businesses don't make decisions. They often will hoard their cash, and so instead of investing in a new facility, a new production line, a new building, they just sit on the cash because they don't like that uncertainty. So then I've got some comments about that relate to psychology about, let's see here. There we go. I was hitting the highlighter instead of the advanced key. So I included this chart just to highlight, well, what are business leaders saying? And if you look at the federal interest rate comment, this was from Citigroup, so this was way back in the fourth quarter conference call, but you say everybody just stayed on the sidelines. And he was referring to just the turmoil that was going on in the fourth quarter, but that reflects that small business sentiment is same idea, that when there's a lot of uncertainty, businesses stay on the sidelines and don't invest their cash, and that is a headwind for the economy. Another comment that I thought you might be interested in was China's slowdown. Organic growth was up 1% versus 18% a year ago from 3M. So 3M certainly is a domestic company, but it definitely has exposure to around the globe. And so they're talking about China there, and they're saying, gee, 1% versus 18%. And you would think that, it'd be natural to conclude, well, if the CFO of 3M is mentioning that, and it's 18 down to 1, what's going on in China, and is that going to be a significant global headwind for growth? And it certainly could be. And this is where it's a little tricky. It's hard to discern what's really happening in China. What we do know, and this gets back to my comment about it is a command economy. The Communist Party is, I think, approaching its 150th anniversary year, and so, or 100th maybe? Anyway, a significant milestone, let's put it that way. They don't want they don't want China to have a meltdown in a celebratory year. So there's a lot of evidence that China is pulling out all the stops on fiscal stimulus and doing whatever they can to pump that economy up, to negate that 18 to 1%. And so China is not as big as the US, but they are the second largest sovereign economy in the globe. And if you've got a government, a command economy, a government determined to promote growth and push growth, that has ramifications for the whole globe, for the US as well as the entire globe. And that's an area where we see it. We have to take it with a bit of a grain of salt because we don't have a full view into China. January often is a big month for stimulus in China because of the Chinese New Year, but this looks like it's beyond the norm. So yes, question. Brexit? That's a great question. Brexit is and Joan, I know you want to talk about it, and it's an area of uncertainty, and it's an area that is affecting Europe, certainly. And it is one reason why we have actually, and I've got some charts at the end, that we've pulled back on our exposure to developed foreign countries in our in our stock portfolios and moved more money into the emerging markets. And one reason is the Brexit debate, the incredible uncertainty with what are they going to do? It's every day. It's like a soap opera, and you just don't know. And so how do talk about uncertainty in business decisions, think of the businesses over in the EU, but also in the UK especially. How can they possibly be making business decisions right now, other than to maybe get the money out and into other countries? So, which leads to your comment about distortion a little bit. So it's a factor, and it's certainly a consideration in our global GDP outlook. I would say it isn't causing us to worry about a recession across the globe because it's not big enough. It has affected our the result on our decision-making process is we have pulled back on our developed foreign, so developed meaning the EU, the Australia, let's see, in the Far East, so EAFE, Europe, Australia, Asia, they call it, meaning Australia, New Zealand, and then the Far East. That component of a portfolio we've pulled back on, and we've added money to the emerging markets. One reason for that is we see that China is stimulating its economy, and we're recognizing it as a command economy, and they have every reason, especially now, given this celebratory year they're in, to keep their economy chugging along. So that's one comment about Brexit. I'll have more as we get going. Tariff and trade negotiations, certainty is something we really desire, and we don't have that right now. That's an example of Ford and other companies like it are, this trade talk and the tariffs and the sanctions and the uncertainty are causing business decisions to be postponed. And then consumer-led economy, we thought this was just such a perfect picture of the consumer. Disney, so you've got the Ford CEO saying, we don't have something we really want. Then you have the Disney CFO saying, the spending, the rooms are rented, the spending at the park is in higher occupancy. Consumers feeling no pain. And that, there are always headwinds and tailwinds, and you can focus on headwinds and you can focus on distortion and be very fearful. The one big tailwind we have is that U.S. consumer. It's not a perfect offset to all the risks, but it's certainly something that we hang our hat on. Let's see here. So I guess we've already talked about this, so I'm going to breeze through it. It's the unemployment versus wage growth. It's just highlighting the consumer. So it's highlighting that we've got very low unemployment. We've had contained wage growth, but we're finally starting to see some improvement. But it's interesting, if you look back to when did we last have low unemployment? When was the black line low? Look at what kind of wage growth we had. Way up here versus the unemployment down here. Now that gap is very narrow. It's improved somewhat, but it's very narrow. And there's hours of discussion into that, but certainly one of them is that businesses have been able to kind of get away without raising wages. I see it, we see it in our own employer. When, like right now, I need to add an employee, and the justification that I have to go through to do that, and then the justification to raise if the world were perfect, the person I want to hire, the job I want to hire them for, I think should have a higher salary. And I will, this isn't unique, so I feel I can share this with you. I'm getting a lot of pushback. And it just highlights that businesses are very concerned about containing costs. And that's one reason why we have low inflation. We talked about the yield spreads, so it's just highlighting that domestically we've got good employment, and we also have liquidity in our markets. And then we get to the international, and so here's a little more talk about Brexit and the European. the EU and the Eurozone, I should say, and China. So this is a chart of purchasing manager index. Purchasing manager surveys are surveys split up into purchasing managers in manufacturing businesses and purchasing managers in service businesses. And then they have the composite of purchasing managers overall. But this is survey information. So this is saying, basically calling up and saying, are you seeing improvement in prices paid? Are you seeing improvement in prices that you're asking for your selling prices? Are you seeing improvement in raw material delivery times? Are you seeing improvement in the employment situation? Are you planning to hire? So these are all kinds of survey questions of purchasing managers. So the data is showing that the US, the 12-month average is the yellow dot, and then where is it currently? We're right at the 12-month average, and that's 55.5 is a very, very strong number. 50 is at a point where it's neither contracting or expanding. It's kind of neutral. And when we came out of the recession, we'd give anything to be at 50. Then we've recovered from the recession, and now we're at 55. You can see the Eurozone was high, the 12-month average was much higher than it currently is. Same for China, same for Japan. And that's probably not enough of a discussion of Brexit, but it highlights that uncertainty with the trade situation and the impact it has certainly on the Eurozone. And when you combine Brexit with the trade talks, you can see the pressure on European growth. And so that's another reason why we've pulled back on our developed international exposure. China, you know that the party is looking at that number and saying, we want that number to be back up. We want current surveys to be reflective of the 12-month or better. And that's they're pumping stimulus into their economy. And then Japan is doing what it can, but that country is limited by its population growth. They don't have immigration in Japan, and so they are going to struggle. They have interest rates, practically at 6 basis points that I talked about earlier, and they can't stimulate enough growth. So they're very connected to the rest of the world. So if you see China and the Eurozone slowing, it's going to have an impact on Japan. Point of reference, I put this in here just to highlight where we're seeing growth. You can see the blue line is the blue bar, I should say, is the latest reading, and then the 5-year average and the 10-year. So here you see the United States. The economy is responding to the monetary stimulus and the fiscal stimulus. The Eurozone, it's got some headwinds. Brexit is a big one. Japan, headwind of population growth. China, it's incredible growth, but it has slowed. And we see this as still very, very strong. And again, the government of China doing whatever it can to boost it. Are they going to go back to 8%? I don't know if they can, because for one thing, Chinese people save a lot, and so it's very difficult to get that economy to boost it significantly, and it's much bigger. So 10 years ago it was much smaller. It was easier to show high growth. Now it's much bigger. So when I hear people say, oh, it's going back to where it was, the growth levels of the past, it isn't. It's mathematically almost impossible. But they certainly are, the authorities are looking at this, and they definitely want to boost that 6.4. And then we have U.S. equities versus non-U.S. equities. This is highlighting earnings growth of domestic companies versus developed and emerging. So here you see that earnings growth of U.S. companies last year, in 2018, was 23.6%. It was very, very strong for U.S. companies. Versus emerging at 7.8 and developed at 5. Profit margins, however, when you look at that, you see how certainly the absolute numbers, the strength in the U.S., but also considerable strength in emerging, and much better than in developed. And so these are some of the reasons why we've pulled back on our developed exposure and are emphasizing emerging markets. We're still overweight domestic, so we're not turning our back on U.S. equities, but we have in our international exposure, we've shifted, pulled some back from developed and moved some into emerging. The message for you is we have not done anything drastic in that area, and I don't think drastic moves are healthy for a portfolio. It's always a matter of degree, and I also consider that when you have a portfolio of U.S. equities, U.S. stocks, you've got foreign exposure, whether you want it or not. And so sometimes I'll hear people say, well, you don't have any foreign exposure, and I think, well, we do. And I always remember a talk with a gentleman in Milwaukee who owned a small little company in West Allis that made industrial sieves. And his business was so small, just to give you an idea, he took me on a tour, which took maybe 10 minutes. And so he makes sieves for aggregates mainly, and so they're huge sieves. And in the corner was a beat-up old Sears dishwasher. And I kind of looked at it and I said, well, what is that? And he said, oh, that's our industrial washer for our parts and for some of our screens. He said, we just throw it in there, turn it on, and and then let her rip. And then he said, and when it dies, and we buy a new one. He said, rather that than spend, hundreds of thousands on an industrial strength washer. And I share that story with you. It was so, the way the gentleman was so funny how he delivered it. But it also highlights that's a tiny little business. If they're buying a Sears dishwasher to wash their parts, it's a small business. But yet he, and this was already several years ago, was very tied to the global economy and global trade. So, which is another theme for why I titled the speech, that it's a small world, but it's a growing world. That small businesses are just as affected by the global conditions as large. And those trade tensions do have an impact, but we're starting to see more opportunity in the emerging markets. And then this is just history about the PE ratios, emerging markets there. You can see on the, oops, there we go. On the right, the valuations are, this is the PE ratio, so it's telling you, well, what price, how valuable is $1 of earnings from an emerging market company versus a U.S. So that's what a PE, when you hear PE ratios, investment people like to use that a lot. The best way to think about it is it's the price per share divided by the earnings per share of the company. An even better way to think about it is if you have $1 of earnings, how much are you willing to pay for that $1? This is telling you that for U.S. large companies, investors are willing to pay about $16 for $1 of corporate S&P 500 earnings. For emerging markets, because there's risk, there's currency risk, there's corruption risk, there's all kinds of risk, they're more willing to pay about $12. And in our opinion, given the headwinds that are in developed countries, especially the Eurozone, especially because of Brexit, we're willing to pay that $12 for emerging market exposure, more so than we are for the developed stocks. So, but it's a nice way to, when you hear PE ratios, that's how I think about it, that's what investors are willing to pay for $1 of earnings. So when you hear of, a high-flying tech company or an IP, like, let's see, Lyft is coming public, and you hear about, well, what are investors bidding that price up for earnings that may not even be true earnings? Those are some of the metrics that you're going to be hearing about in the headlines. Let's see here. I've got global fixed income. I'll breeze. I'm starting to speed up because A, we're running out of time, and B, I know you want to talk more about Brexit. This is just highlighting global yields. So when I was talking about money flowing and where is it finding attractive yields, and then the strength of the dollar, this is one thing I was referring to is, we're not perfect in the U.S., but 2.6%, and I can get 1.17% in the U.K., which arguably has a lot of challenges in front of it. I can get less than 0.07% in Germany, negative rates in Japan. U.S. at 2.6 is pretty darn attractive. And that also is a reason why we feel interest rates for us certainly are going to remain contained and low, because relative to the rest of the world, we're a great deal. So why wouldn't money flow to the U.S.? And then when you think of a bond, a U.S. Treasury note, more money buying it, the price goes up. And with bonds, the one given is when prices are up, that's telling you rates are low. It's a teeter-totter. And so when you hear bond prices are rising, it's telling you more demand, yields are dropping. So we've got that's another example of the puzzle and the interlocking relationships that we're dealing with, and the reason why I chose the title I did for today's comments. And so I've mentioned that we've pulled back on developed international exposure and moved in emerging. It's hard to see up here, but what I'm referring, this I just included in case you're wondering, well, what are you doing? What is BMO doing? And what should I be doing? Not that you should follow BMO, but as I mentioned before, we have adjusted our portfolios a little bit to pull back. So the gray bar is where we were a month ago, and then the black little diamond is where we are now. We have more, we have an underweight. We've moved more toward the underweight for developed, and then therefore the emerging. We've emphasized that a little more. Another thing that you should see on this is cash. So now this is interesting, and it's something to consider. Cash, first of all, professional money managers were often criticized for holding any cash in a portfolio. People say, you're not doing anything with it. Why would I pay you to have it in my portfolio? I can see that, especially when that cash was earning 0.01%. It's a fair assessment. It's also a fair assessment if cash is 10, 15% of a portfolio. But note that it is a result of investment decisions being made. And so I'm on the asset allocation committee for BMO as a whole. When we talk about where areas we want to emphasize or de-emphasize, cash is part of the decision-making process. When it was yielding virtually nothing, it was very difficult to decide to have any cash because it does open us up for criticism. Now that we're able to pull in, almost 2%, this doesn't reflect. I think the decision was made in the late fall, but that cash position is higher than it's been in the recent history, and it's because the rates are a little bit better, and we've got high asset prices. What have I talked about? The Federal Reserve, the central bank stimulus has boosted asset prices. Some of the valuations are a little high and cash returns are a little bit better. So cash is more of a viable asset class in our portfolios. And you're probably noticing that the banks are offering to pay more on savings. Some in some instances and not in others, but generally speaking, those rates have moved up. So you're not penalized as much for having, so like the problem with such low rates is if you were, if you had a drop dead date of a need for cash, either maybe you were planning to buy a car, maybe you were planning to buy a condo, maybe you just knew that something was coming up that you needed to have reserves on hand for, the terribly low interest rates really penalized you. Now, not that I'm doing cartwheels about 2%, but it is better than 0.2%. And so we've noted that in our own portfolios. And let's see. And here, this is another for you. So now here's some takeaways for you. This is a crazy quilt. Sometimes they call it the investor's periodic chart. It highlights all different types of categories of investments. So large cap growth, meaning large U.S. companies, non-U.S. stocks, investment grade bonds, junk bonds. There's a lot on this chart. What I like to highlight for people as a takeaway is, first of all, how often what was high one year in terms of return is often at the bottom or near the bottom either the next year or in 2 years out. So that you're no matter how good you might be, no matter how good the professional you might hire might be, you're never going to find somebody who's going to know what's going to be the peak one year and then when should they get out and get into a new category for the next. It's impossible. What keeps me from banging my head against the wall and what I think is such an encouraging message for personal investors is if you look at I wish the colors were a little different, but the gray box, which is called asset allocation. So on your chart, on their paper, it's labeled asset allocation, and it stands for a portfolio that's 60% in stocks and 40% in bonds. That's a very common asset mix for institutions, for nonprofit boards, endowments, because it gives the potential for growth, but it also provides a foundation of some stability from the bond market. And what I find encouraging, and what I hope you see too, is that gray box, it's never at the top, it's never at the bottom, and it's always kind of, it's a little bit above the middle usually, and it's in a band. And actually that band is a very acceptable return over time. And that tells you that if you go about this in a reasonable fashion, you don't put all your eggs in one basket, you don't bet the farm, you can have a beautiful portfolio that is going to do just fine. You hear somebody at a cocktail hour raving about how they were up 18% last year and the market was down 4%, and you might kind of hang your head and think, well, I wasn't quite that range, but you're not going to get in trouble either, and you're going to have a healthy return over time. So that's one of my closing charts. And then this one too, I included because I do talk to a lot of people who, especially after December, they say, I'm sick of this. I just want to put my money under a mattress. My own sister has told me that. My own sister. I've tried to make her a convert, and I'm getting there, but she still will call, after a bad day, she'll call me up and say, I'm sick of this. But when you see what has happened to money in a mattress, oops, I did it again. Here we go. That's the red line. $1 million, 10 years, it's down to $835 when you figure in inflation. Cash at a bank, $1,038,000. Investment grade bonds, you know, you've got to gain $1,004,000. 60-40, so there's that mix again. So that gray box in the periodic chart, 60-40, 60% stocks, 40% bonds. $1 million in 10 years, 2.2 million 10 years out. That's, you know, that's a livable goal, I would say. And you've avoided all those ups and severe downs. And that's as an investment person, that's what makes me very hopeful and optimistic and happy to be in this industry. This is another chart just highlighting the power of discipline. You've probably seen these charts. It highlights how, and this is going back to why I said investors are try to be long-term, because if you do miss a good day, you can do some significant damage to your portfolio. So the message is, if you stayed fully invested, you'd have an annualized return of about 5.63% in the last 20 years. If you just said, I'm in and I'm just putting it in a drawer and leaving it. If you said, ooh, I'm out, I'm in, I'm out, and I missed just 10 days out of, I figured it out of, if you figure trading days over 10 years, about 5,000. So 10 days out of 5,000, your return goes to 2.02%. That's why we say don't knee jerk and yank all your money out at once. You know, if you're losing sleep, listen to that and maybe tweak around the edges, but don't get out of the markets full bore because of some bad headline, because they typically come back, but you never know when that's going to happen. And then here's my final chart. I found this postcard in a gift shop, and I thought, oh my God, I bought them out. I am a Luddite. I like paper. You can tell I've got all my paper and my stuff here. So it's unusual for a paper person who still knows what a telephone directory is and looks like, even though all my coworkers don't. It's unusual for me to say I am a big fan of technology, because I do like my paper, but I am a fan of technology as an investor, as an economic outlook person, as a speaker. It's not perfect. And again, as I mentioned, there's some destruction that technology brings us. But when you think of the impact, like just think of, now it's in the headlines of the 5G, the world of 5G, internet speed. I mean, that could be like another industrial revolution. It's the impact, the productivity increase, the innovation. And so I highlight this to say, just, you know, when you read some dire predictions, again, we're not perfect, and there are problems out there. I don't mean to sound like a Pollyanna, but there's so many offsets that we can't even begin to think about that are coming. And we've got so much talent out there that's thinking about all these ideas, and there'll be some new things that we can't even predict. But I firmly believe that they lay the bedrock for a positive outlook and for a positive investment portfolio. And I'll stop, and then we can fire away with questions. We don't have a lot of time, but I encourage you to ask.
Any question? Go ahead.
Yes.
Deficit.
That is a great question. So everyone here, what about the deficit? What about the deficit, and linked to it, what about the debt? Oh my gosh, I mean, the numbers are unbelievable. And when you think that we are we're in the late stages of an expansion, and they're spending all this money, I mean, this is when you should have a bit of a surplus to help prepare for when we do have a recession. And oh my gosh, we're going in the exact opposite direction. It's a great question, and I wish I had a really great answer. I have an answer, but it's not the best. And partly, so I've been asked that question for the 35 years I've been speaking, because it's on our minds, and especially now. So a subset of your question was, well, what about China being such a buyer of our debt? What if they say, screw you, and I'm gonna go elsewhere? The good news about that is they really can't. So when you hear there are these doomsday articles about if we continue to live beyond our means, nobody's going to buy our debt. We benefit from the fact that we are the biggest global economy, biggest economy on the planet. That we do have a market-based economy that is growing, that is open to innovation. That has grown and has outgrown past deficits. So the argument that someday somebody's going to turn their back on our debt market I don't mean to sound completely dismissive. And I do worry about things like this, but I would say that it is something that we really don't need to be. We need to be respectful of our position as the leader, the global leader, and a safe haven for investors. We definitely need to be respectful of that. Because of our size and the markets, there just aren't worthy alternatives. So I don't think we need to worry fully about an investor like China turning their back on our securities. Now, getting back to what about just the size of the deficit and the debt, my answer to your question is not my favorite, but it's an answer that I have come back from again and again, and that is, it hasn't been a problem so far. And so when I think back to 30 years ago when I got that question, and if I had said, ooh, you're right, let's be conservative with our investments, let's not take risk, I would have given horrible advice to an investor. And I hate that I don't have a better answer, but it's like we continue to be able, because we are we have the reserve currency in the globe, we have the best overall economy on the globe, we're able to keep issuing debt. And now what's interesting is the conversation, as you noted, has shifted. So there's a lot of concerns still, but there's this new factor out there called modern monetary theory, MMT, that you're probably starting to read about in headlines, and it's the idea of, hey, why would we worry about deficits and debt at all? We are the reserve currency. We are the best economy on the planet. We can just keep going.
A topic for another day.
Yes.
A topic for another day.
But it is a debate, and so it's out there. So
join me in thanking Sarah, and also for a rainy day.
Oh, thank you. I always good to be prepared.
Hopefully we don't see any for the next couple of weeks. Thank you very much.
Thank you very much for your attention. It was wonderful to talk to you, and I hope you've been helped, and I'll be around if you have questions in addition. So thank you.